Okay, let's just dive right in. We've got a massive stack of market intelligence covering the last, 24 hours in Bitcoin. It's been wild. Our mission today is to cut through all that noise. We need to distill this down into something actionable for you, focusing on the price volatility, the huge regulatory shifts, and some of these long-term threats that people aren't really talking about.
It's a critical moment, and I think it's important to understand the complexity here. The market isn't just moving one way. It's really defined by a collision of forces. On one hand, you have these powerful bullish catalysts. I'm talking historic regulation, big liquidity injections. And on the other, they're running headlong into some pretty fundamental bearish signals, deep skepticism, real technological risks. So our job is to figure out which forces are driving the short-term drama and which are quietly building the market structure for the next 5 years.
Let's start with that drama then, the overnight action. It was just whiplash. Bitcoin collapsed near $84,000, which felt like total panic. And then, bam, it rebounds, recovers all the way above 93,000. That's a huge swing, like 8 to 10% in just hours. What on earth drove that?
Well, that move wasn't a sudden rush of, fundamental demand. It was primarily mechanical. If you look at the liquidation data, nearly $500 million in total crypto liquidations were recorded. But the key number, the one to watch, is the Bitcoin short liquidations. We're talking somewhere between 196 and $226 million.
Exactly. It's a classic short squeeze. The price hits certain levels, like that $93,000 mark, and it just triggers automatic liquidations of short positions. And that creates a self-reinforcing loop. The forced buying generates its own momentum, and it moves up really fast. But here's the question then. If it was all mechanical, how worried should we be that there's no real support under this price? Are we just setting ourselves up for another leg down once that pressure is gone?
That's the concern. Analysts are widely viewing this as a tactical bounce, and the Fear and Greed Index backs that up. It's still sitting at 23. That is firmly in extreme fear.
Which makes sense when you zoom out to the wider economy. We can't ignore the macro warnings right now. I mean, you have people like Elon Musk sounding the alarm on the $38 trillion U.S. debt crisis, saying it could completely transform our monetary system.
And that's exactly why the Fed's moves are so critical for risk assets right now. We just saw the formal conclusion of quantitative tightening, or QT.
Okay, for anyone who isn't a Fed watcher, can you just quickly break down what concluding QT actually means for the market?
Absolutely.
Yeah.
So quantitative tightening is when the Fed shrinks its balance sheet. It's basically sucking liquidity out of the financial system. So ending QT means they're taking their foot off the brake. And not just that, they followed it up with a $13.5 billion overnight liquidity injection.
$13.5 billion, that sounds huge. How did they do it?
It was a repo operation. Think of it like a very short-term loan to banks. And this was the second largest single-day repo since the height of the COVID panic. It's a huge signal the Fed is addressing funding stress. And the market sees this. They're now pricing in an 87 to 89% chance of a rate cut on December 10th. The outlook is dovish.
So the U.S. is easing, which is bullish, but then you have this major counter pressure from the Bank of Japan, right?
That's the wild card. The BOJ's threats to hike rates are throwing a wrench in the works, specifically because of something called carry trade mechanics.
Okay, break that down for us. The carry trade. It's mentioned all the time as crypto funding, but it's a bit of an opaque concept.
Sure. Essentially, you're borrowing in a currency with a low interest rate, like the Japanese yen, and investing in an asset with a higher return somewhere else. So investors borrow yen for cheap, sell it, and buy things like U.S. treasuries or, yes, high-risk assets like Bitcoin. When the BOJ threatens to raise rates, the yen gets stronger. That makes it more expensive to pay back those loans. So investors are forced to sell their assets, including crypto, to cover that yen debt. It puts a cap on the upside. And you see that with the U.S. dollar index staying firm near 99.4.
Okay, so if the market mechanics are a tangled mess, the regulatory side is actually getting crystal clear. And this is where it gets really interesting, starting in the UK.
This is a landmark moment, more than just a footnote. The UK Parliament just passed the Property, Digital Assets, Etc. Act 2025. And this act officially recognizes Bitcoin, stablecoins, and NFTs as a distinct category of, and this is the key phrase, personal property.
Personal property. So why do those two words matter so much to institutions?
It completely removes the legal gray area. Before, institutions were dealing with massive uncertainty. But by defining Bitcoin as property like a share in a company or a house, it suddenly plugs into decades of established law.
You get certainty on custody, inheritance, fiduciary duties, all of it.
Explain that fiduciary part. Why does that make a fund manager feel safer?
Well, big institutions have a fiduciary duty, a legal obligation to act in their client's best interest. If the asset itself has no clear legal definition, that duty is ambiguous. By calling it property, the rules for how to handle it, how to recover it, how to value it, they all just snap into place. It's the green light they needed.
And then on an even bigger scale, we have this massive tax reform coming out of Japan. This might be the single biggest policy shift in a major economy this year.
Oh, it's monumental. Japan is moving to slash crypto gains taxes from these punitive progressive rates, which could go as high as 55%, down to a uniform flat 20% rate.
Wow. So that puts crypto on par with traditional investments like stocks.
Exactly. It aligns crypto with equities. And the difference between 55 and 20% isn't just a tax break. It fundamentally changes the investment incentive. At 55%, crypto is treated like gambling income. At 20%, it becomes a legitimate asset class for a long-term portfolio.
And we already know Japanese institutions are hungry for it. Firms like Metaplanet already hold billions in Bitcoin, even under that old system. What happens now?
Well, the floodgates could open. The reform is expected to be formalized in late 2026, and it's going to stimulate both retail and institutional money that was sitting on the sidelines purely because of the tax complexity.
But at the same time, we're seeing enforcement against illicit actors getting much tougher. It sounds contradictory, but you're saying it's a sign of maturity.
It is. A perfect example is Europol dismantling CryptoMixer last week. This service processed over €1 billion in illicit Bitcoin. They seized 25 million euros in Bitcoin, and crucially, 12 terabytes of user data.
And this ties directly into the EU's new framework, MOCA.
Precisely. This is Europol executing on MiCA's mandate, which explicitly bans mixing services on privacy coins like Monero by 2027. And here's the paradox. This kind of rigorous enforcement actually strengthens institutional legitimacy. Big money isn't scared by this. They see it as a sign that regulators can manage the space, which gives them the confidence they need for mass adoption.
Speaking of big money, let's talk about institutional positioning. We're seeing some huge moves. What's the deal with the massive stablecoin issuance we just saw?
We have to talk about the dry powder. Circle just minted about $7.5 billion worth of USDC, and it was targeted specifically at the Solana network. A stablecoin mint of this size is a major leading indicator. It's cash on the sidelines, ready to be deployed.
$7.5 billion landing on Solana. What does that signal? What are they planning to do with it?
It's the combination. Solana is a high-speed, low-cost chain. So this scale of injection suggests preparation for something sophisticated, like high-frequency trading or large-scale DeFi deployment. Either way, that volume acts as a powerful backstop for prices. It signals deep capital reserves ready to buy any dip, which totally contradicts that extreme fear we talked about earlier.
And the institutional appetite is clearly moving beyond just Bitcoin and Ethereum. Franklin Templeton is making some really bold moves here.
They are leading what you could call the ETF 2.0 phase. First, they filed for a spot Solana ETF, ticker SOEZ. Just by doing that, they're validating Solana as the third pillar of institutional crypto, right alongside Bitcoin and Ethereum.
And they're getting aggressive with it, too.
Incredibly aggressive. They're using a loss leader strategy, waiving all sponsor fees on the first $5 billion in assets. That's unheard of. It shows how critical they see this product.
But it's not just the Solana ETF. They're also building a passive index product for wealth managers.
Exactly. They expanded their Franklin Crypto Index ETF, easy peasy, to include Solana, XRP, and Cardano. This is crucial because many wealth managers can't pick individual coins due to compliance, but they can allocate to a diversified index. So Franklin Templeton just created a structural passive demand for these other major altcoins.
And quickly, let's touch on market infrastructure. Binance, the biggest exchange, is making a significant leadership change.
They've moved to a dual co-CEO structure. Co-founder Yi He is joining Richard Teng. It's a clear sign of maturation. You get He, who's focused on product and community, balanced with Teng, who brings regulatory and institutional credibility. It's about professionalizing for a much more regulated world.
Okay, now we have to bring in the counter-arguments. This is where the perspective really sharpens.
Yeah.
Michael Burry, the big short guy, just came out of his media hiatus right during this correction to unload.
He did not mince words. He compared Bitcoin directly to the 1600s tulip mania. He called Bitcoin at $100,000 the most ridiculous thing he's ever seen and labeled the asset itself worthless. The timing is what's significant here. He shows up during the correction, which suggests sophisticated concern, and he frames it purely as a speculative bubble.
And you can see that skepticism playing out in the market. There's this huge disconnect between Bitcoin's rebound and some of these crypto-related stocks.
Absolutely. Look at American Bitcoin Core, or ABTC, the firm co-founded by Eric Trump. It plunged 40 to 50% in a single day. The stock is now down 78% from its peak, even as Bitcoin itself was recovering.
So why did that stock get crushed when Bitcoin was stabilizing? What was holding its value up before?
It was what analysts were calling the Trump premium. It was a bet on a political narrative, on deregulation. Its collapse signals a major rotation. Capital is moving away from these high-risk, narrative-driven plays and toward regulated infrastructure, like the spot ETFs. The market is demanding fundamentals now, not just a good story.
Let's shift to the really long-term threat then, quantum computing. This has always felt like science fiction, but the timelines are getting shorter.
It's a very real technical time clock. Experts are now giving credible timelines for when quantum computers could break Bitcoin's current cryptography, which is called ECDSA.
ECDSA. In simple terms, what is that and why is it so vulnerable?
It stands for Elliptic Curve Digital Signature Algorithm. Think of it as the mathematical lock and key that protects every single Bitcoin wallet. If a quantum computer can break it, it can figure out your private key just from your public key, which means it can steal your Bitcoin. And researchers estimate that a powerful enough quantum computer, about 1 million qubits, could be here by 2030.
Wow. And what's the scale of the risk today? How much Bitcoin is vulnerable?
It's staggering. Over 6.6 million Bitcoin, worth about $745 billion, are at immediate risk. These are coins in wallets where the public key has already been exposed. Once a quantum computer is ready, those coins are theoretically up for grabs.
So evolving the protocol isn't just a good idea, it's an absolute necessity for survival.
It is, and we're seeing the very early stages of mitigation. It's extremely complex. A company called BTQ Technologies demonstrated a quantum-resistant implementation in a proof of concept. But this requires a fundamental, deep-level protocol upgrade for the entire network. It's a massive undertaking that has to happen before that deadline hits.
So after all that, what does this mean for you, the person trying to make sense of this? We have this incredible tension. On one side, foundational regulatory clarity from the UK and Japan. On the other, deep skepticism from people like Burry and this ticking time bomb of quantum computing.
And to help you weigh those forces, I'll leave you with one key on-chain data point. Long-term holders, the investors who ignore this daily noise, have, for the first time since April, started increasing their holdings again. It's a quiet signal, but a powerful one. It suggests seasoned investors see this as an accumulation phase, and that Bitcoin might be trading below what they consider its on-chain fair value.
So here's the final thought. Given that institutions now have legal certainty and easy investment options like index ETFs, which factor holds more weight for the future? Is it the incredibly complex but necessary migration to quantum-resistant tech? Or is it the simple, relentless force of fiat devaluation and global debt pushing money out of the old system? Something to mull over until our next deep dive.